Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonell and Jack Forehand are principals at Fairlead Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Fairlead Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Fairlead Capital.
Hi guys, this is Justin. In this episode, Jack and I sit down with Katie Stockton of Fairlead Strategies to talk about her personal approach to investing and how she thinks about her investments and what is important. We talked to her about her tactical ETF strategy, which she invests in, her views on managing risk, why she uses a financial advisor for parts of her investing and planning, and how she thinks about kids and money and much more. Toward the end, we get Katie's views on the current market trend and where she's seeing opportunities. As always, thank you for listening. Please enjoy this discussion with Fairlead Strategies' Katie Stockton. Katie, welcome back, and thank you very much for joining us.
Thanks so much, Justin. Happy New Year.
Happy New Year to you. Most people that I think have seen you either maybe on our podcast or certainly CNBC and other media outlets sort of know of you as, being out there talking about the markets, talking about technicals, talking about different asset classes and how, investors should be looking to position their portfolios tactically. And I think, for the long run as well. And we're going to get into some of that with you because while we have you, we're going to take advantage of that. But what we thought we would do is sort of talk to you about your personal approach to investing and some of your views on the things that we're going to talk about. We do this Show Us Your Portfolio episode where we talk to professionals like yourself that kind of give our audience insights to how they think about their own portfolios, how they think about compounding and growing wealth. And there's always really interesting little nuggets that come out of these because people like you have been in the markets for a while. And it's always interesting to see how your expertise translates into sort of how you go about managing your own money. So this is going to be really cool. We really appreciate it. Thank you so much.
Of course. No, I'm happy to go down that path with you guys. It's a little different for me, but I think it definitely is relevant. And as you know, I'm a technical analyst, so I am sort of narrow in my expertise. And it's taken me probably the whole 25 years of my career, 25 plus years at this point, to kind of figure it out myself. So
when you think about your long-term goals and what you're trying to accomplish with your portfolio and your investments, how would you sort of capture the essence of that?
I think the key is long-term. And this is something we actually sort of learned more recently. I joke that I wish I had been more long-term in my focus a long time ago. It's easy to become short-term as a technical analyst because you're really close to the markets, right? So you do, by the nature of our sort of day job, get caught up in the day-to-day swings. So it's really dynamic, and honestly, it's really hard as a technician and someone who's so close to the markets to watch anything go against me in terms of my portfolio. So because I am so close to the markets, but I also have learned that the long-term focus is really key in investing. It is how you build wealth, and that we have to be okay with some drawdowns. And we have to really take the long view in taking positions and not get too caught up in the short term because the short term can be just noise. So we've learned that the noise doesn't tend to help us a whole lot. And I think that's probably something that's common out there, that we can easily get caught up in the short-term swings and repositioning too frequently, and therein also incurring, more transaction costs, more tax implications, et cetera. Whereas if you had just kind of held throughout a certain, period, maybe a consolidation phase or something like that, you would have been well served by doing that. So we have learned as we've gone along the way that long-term investing is really key.
I'm curious, how often or much do you think about your retirement? I mean, you're building a business at Fairlead with your team, and you have the research, you have the asset management, but do you take a step back sometimes and think about, this is what I want my retirement to look like? Or is that so far off in the distance that you're not really thinking of that?
It's definitely far off in the distance. I do kind of feel like I'm one of those people that will never stop working. I see people like, Louise Yamada, who's a very well-known technical analyst, or Art Cashin, who's going to do it to the day he dies. And I really respect them and appreciate their passion for the markets, and I can't say I can match them in any way, but I do have a passion for markets. So I expect to be doing this for a long term. Maybe it morphs from doing it, in this capacity at Fairlead to something that's more personal. So I have no eyes on the prize of retirement at this point. And yet, every time you look at your accounts, you do think about it, and you think about it as it pertains to your lifestyle, and it honestly stresses me out quite a bit. I think I'm probably not alone in that. To think that there's just not enough, right? So it's definitely on my mind. I can't say I think about it, every day, but certainly, once a month, I'm really checking in on things and making sure that I'm on the right track.
Yeah, it's interesting to your point about not retiring. I mean, that's something we commonly hear on these, and all of us, I think, to a large extent, like derive a huge part of our purpose from like what we do, and that's a big thing you see with people that retire is when they kind of flip that switch, and it's just it's on one day and it's off the next day, like that gets lost. So I think that's important, to keep attached to something you like as much as you like markets, as you move forward, even if it's not something you're doing full time.
Yeah, for sure. And I do enjoy it. I also enjoy like the human element of it, right? Just working with people and having something to wake up for. So, and you do see that, Jack. I think where we've all had friends and colleagues retire, and they often go into sort of a mode where they want to do something. They want to do something that's less, onerous, I guess, in many ways, but they really want to have like a new project. I just talked to somebody over coffee last week who is in that position, sort of retiring from the big time, position, but wanting to take their experience and do something a little bit different with it. So I understand that because what I do definitely defines me. It's sort of a constant, because I have my own company too. It's constantly on my mind. So and I enjoy it.
Yeah, there's only so much, a lot of people think they're going to retire. I'm going to play golf, 5 days a week. And eventually that gets old pretty quick, I think, as much as people think they
golf,
can do
it. The golf courses don't want me. So it's not an option.
I'm a pretty horrific golfer myself. So when you think about your portfolio and you just think at a high level about like the asset classes you're looking at, your stocks, your bonds, your alternatives, like how do you think about that? How do you think about like putting that together, like the asset classes you invest in, and then how you put that together into a portfolio for yourself?
Yeah, and the whole like asset allocation conversation, for me really became more real when I developed the strategy behind my ETF, because that became a holistic portfolio in and of itself of different asset classes. And I'll be honest, before that, I really was more equity focused. I just would buy stocks or buy equity ETFs. I really never got too deep into fixed income. But now, once I'm sort of at the stage where I am thinking, 10, 20, 30 years down the road, and I need to ultimately get a bit more conservative, right? I am thinking more about asset allocation. The way I see it is that it may look something like 60-40, in a strategy that we would develop like the ETF, but it needs to be dynamic. Right. So the key is that it shouldn't be a static percentage of, say, fixed income versus equities. And by the way, there's other asset classes too, right? So we have commodities and precious metals within that. So I think all of that, really needs to be dynamic. So I can't say that there's an answer right now that this is, what it is and what it will be. But I do have more attention to it now in my own portfolio, primarily via my own ETF at this time. But I think it's important as a way to diversify and obviously manage risk that is associated with an equity market that has much more volatility, now than it has in certain environments in the past. So we have to have ways to navigate those environments.
Do you use technical analysis like on the majority of your portfolio? It's interesting when we talk to people who have a specific skill in the market. Sometimes they say, I completely apply that to 100% of my personal portfolio. Sometimes they also say, that's what I do during the day. I don't want to focus on my personal portfolio. I kind of put it away in the Vanguard stuff and I just leave it there. How do you think about that?
A little bit of both, I would say. So I have, compliance that I have to follow. I have to be compliant as an SEC registered firm. and a FINRA registered investment advisor. And with that, honestly, we have generally shied away from individual stock positions. I still do buy stocks. I bought NVIDIA on its breakout for one. So I do, look for high conviction types of setups in the charts and let that be my guide. I do have to trust in a way the fundamentals are strong there. So I'm trusting the markets sort of rewarding certain stocks with a long-term uptrend, essentially. So I'm much more inclined to buy a stock that's in a long-term uptrend that has some kind of positive technical catalyst, as opposed to something that's a turnaround. But I also think, with the turnarounds, you tend to get a higher beta type of position, right? So if you believe in sort of the industry, at least, if not also the company itself, it's certainly worth having smaller exposure that is more in that kind of realm, depending on the environment. But I'm really very top down in how I think about things. When the S&P 500 is working, well, then most stocks are working too, right? So, and then vice versa. This is where the fundamentals are challenged, because there will be environments for weeks, months at a time when the charts and the trends just don't reflect, honestly, the company's fundamentals. So I could never invest in anything without seeing the chart. And truly at this point, because I'm sort of an old dog, I need not only the chart, like I can't just look at a price chart, I need all my indicators too. So there have a lot of tools that we're using, momentum-based indicators, overbought, oversold measures. And so I'm a little bit sort of, I guess, stuck in this discipline at this point. But it has helped me over time identify opportunities. It is my primary input when I'm investing, but I am also trusting that the markets are rewarding certain companies. And therein, I kind of try to stick to those realms when I'm investing on the individual stock level. I do believe that you can, invest in sectors and major indices, whether it's via ETFs or otherwise, really just with technicals on your side, because you're really making a bet on the momentum and relative strength, right? Whereas the individual stocks, I think you really want to have the earnings trends and other factors and a strong management team and governance on the side of that position. So there's a little bit more to it there, and that's not lost on me. So what I do, I trust my financial advisor to manage a portfolio for me, but then I also have, money that I work on myself. So, and the managed portfolio will be mostly individual stocks, right? So I'm trusting the advisor to have, strong research behind his process. And then I also don't then run into the compliance issues of going in and out of these individual securities that I may or may not at any given time feature in my own research, right? Which is where the issues become sort of a regulatory problem. If I let's say if I owned a stock and then I said in my research that it looks poised to correct, well, that could be obviously confused and misinterpreted by the end user and by the regulator. So I trust the advisor to do the individual stock portfolio primarily. And then I'll have my own positions primarily in our ETF, just because that's a whole portfolio. And then I'll supplement that with some smaller positions.
Yeah, the financial advisor point is a really important one, because we see that a lot. Like, people think that those of us that are in the business won't benefit from a financial advisor, but a lot of us do. I mean, just having somebody outside of yourself who can take a look at what you're doing, you can benefit from that, even if you're really skilled and you're in markets day to day. There's benefits to having that type of thing going on.
Yeah, I never thought about doing it all myself. I do have a lot of clients, research clients, who do try to do it themselves, and I can see their frustration. Sometimes it starts with the frustration with their existing advisor and their underperformance, and they try to do it themselves. But I find that they do often ultimately go back to an advisory relationship, because not only is it's just high maintenance, right? There is a lot of administrative stuff that can come with it too, that an advisor is going to facilitate. So, I think for the most success, it makes sense to have an advisor and to do so with a little bit less of a headache on some of the administrative things that come up with it. We all, I think, benefit from not just, portfolio management, right, which is more what I'd be focused on, but also financial planning. So an overall view of your whole sort of net worth and the retirement prospects with that in mind.
You mentioned your ETF and the allocation strategy behind it. Can you just talk a little bit about, because I think that plays into how you're doing things with your personal portfolio. Can you just talk a little bit about the strategy behind that?
Yeah. So, and this is by no means a pitch for my ETF, but it's kind of what I believe in, right? That's why we launched it. So it's called the Fairlead Tactical Sector ETF. So what we're doing with that ETF, it's an ETF of ETFs. So, and I really believe in ETFs as a good product, which is why my product is in that wrapper, because of the sort of the advantages in terms of cost for one versus sort of private funds. But also for tax implications that you tend to get with mutual funds can be a little bit more more of a nuisance, right, on a year-over-year basis. So I like the tax implications from ETFs, and I like them as a wrapper that allows for a more affordable way to invest in certain strategies. So what we've done is found some very low-priced ETFs, meaning very low expense ratios. So we take 14 ETFs, of which 11 are sector funds. If you think about like any given year, the sector dispersion is so massive. You can have, a 60% spread in relative performance, which is, or even more than that from the biggest winning sector and the biggest losing sector year over year. So we feel like that's something that investors should try to take advantage of, right? By kind of having positions that are concentrated in those winning sectors and vice versa. So and avoiding the sectors that are underperforming or that just don't have the momentum behind them. So that is our primary goal, is to leverage the sector rotation using our long-term technical indicators. We're just rebalancing monthly and falling with sort of my belief that long-term investing is the way to go. And with that, we're just trying to ride long-term trends and make sure that there's still the support of momentum, relative strength, and there's no big overbought sell signals, say. Now, we'll, of course, get into environments where risk management is more important. So what we found is this is where asset allocation comes in. Of course, you have ways to, you can use like a stop loss discipline, but you can almost like lean on the indicators to do that for you. So either you can do that through, let's say you owned NVIDIA, and you said, I just don't want to see it go back below its 50-day moving average. Great, that is a way to manage risk, but it is actually pretty high maintenance too, to monitor that yourself in a portfolio. So rather, we like a systematic approach where it's kind of doing it for us and doing it via sort of a look at momentum gauges. So when is momentum shifting enough to suggest that this is more than just like a pullback, right? This is an actual reversal that we want to get out of the way of. So that's what we're trying to measure and avoid those big drawdowns. So that's really key, is to avoid the big drawdowns. And over history, that's how you can beat the S&P 500. It's not necessarily via stock picking. There are good stock pickers out there, of course, but I really feel like it's by avoiding those 2008 types of periods. That's where you get that long-term outperformance. And if you can do that with sort of more safety in your positions, meaning like less volatility, lower standard deviation, lower beta, to give you some peace of mind, that's our goal through the asset allocation. And what we found in our back testing of the strategy is that it wasn't like a shift fully into fixed income, but rather a combination of fixed income and precious metals that got us to a place where we felt like we liked the outcome. And so we have short-term treasuries as an option, long-term treasuries, and gold that we're able to invest in through low-priced ETFs. So those become our kind of defaults, divided about a third, depending on a couple of factors. So we default to those asset classes when we don't have enough sectors kind of filling our requirements. So that's the dynamic nature, right? So we'll shift, I call it more risk on or risk off, based on the long-term trends behind those sectors.
On the momentum, factors, could you just shake out? So let's say you have, a sector exhibiting strong relative strength and momentum. And then how do you identify? I know it can be tricky because not every decline is going to be further declines, it could, they could turn on you and go the other way. But what type of momentum indicators are you looking at to get at whether that momentum it's really losing momentum and not just like a temporary pause?
Yeah. And I mean, the model behind TAC, that's the ticker for the ETF TACK, is proprietary, but if anybody knows our research, I know we've discussed it in the past. It looks very much like the tools that we're using on a day-to-day basis. We have moving averages, of course, that are great, the sort of gauges of prevailing trends over different time frames. We have the MACD indicator, which is a very common technical tool to discern momentum and sort of trend indications. We have something we call the cloud model, which is also known as Ichimoku. It's a Japanese model that helps us stay on the right side of the trend. So it's really kind of a combination of indicators that will give us that momentum takeaway. And then we have another sort of combination that will give us a sense of how overbought or oversold something is. And does that mean it's providing opportunity or that risk might be heightened? And then we can combine that to understand what the relative performance is, because we are trying to find those leading spots within the market, right? And that, is something that we check for individual stock positions. We look for trends of long-term outperformance. And that's simply just take a ratio, right? And identify the trend versus whatever your benchmark is, the S&P 500 index being the most common one, I'd say.
How do you think about technical analysis on bonds? I mean, I've seen it done different ways. I mean, some people actually do like pure technical analysis on bonds, looking for areas, where there's momentum to get into those areas. Other people tend to do it, I think, the way you're sort of doing in your ETF, whereas bonds end up being like a risk-off type thing. You're looking at some other asset class, and then when the momentum breaks down in those asset classes, you end up in bonds. Like, how well do you think technical analysis works on bonds?
Well, I would say technical analysis works best. It's really all on the sort of end user, right? But it works best for commodities and FX, right? Because those, I would say, are probably the purest in terms of supply and demand. And they're also often the most liquid markets, right? So you have high liquidity, so the charts are really kind of clean. They really mine support and resistance levels, in part because the traders are using technical analysis. And you have just more of a clean sort of supply and demand relationship that, it's kind of economically related, right? But it's, there's less headline risk versus an individual stock, as an example. I would put, treasury bonds somewhere kind of in the middle, because there's a bit more, obviously, of a macro dynamic that comes into play there. And because of that, you obviously have to look at price and yield, and you have to have it within a broader sort of economic context, a sense of what the macro trends are, not just the technical trends. So I'd say just with treasuries as one, there's just a little bit more to it. So it doesn't mean that technicals don't work, but are certainly, they're enhanced by understanding the macro trends. And for individual stocks, we always have key levels that we can watch where risk increases or decreases, in our opinion. And so we always know where something is going to change. So that's kind of the beauty of technical analysis, is it is somewhat unbiased. It's like, okay, well, we have this stock or this position, and below this certain level, well, risk increases that the downside momentum is strong enough that we want to be out of that position. You can have those levels that are derived from support and resistance, and therein have like a little bit less of a bias. It's like if a level is taken out, you can't really argue with it. And that crosses all asset classes, right? So some of the very basic concepts like support and resistance from technical analysis certainly apply to fixed income. But there's just a little bit more to it.
You mentioned on the equity side, you've got an advisor who's doing some individual stock stuff. You mentioned then you've also got the stuff you're doing with your own strategies. Do you do anything else there? Like, do you have like buy and hold S&P 500? Do you like factors like value or anything like that? I mean, that seems kind of the opposite of what you do, but do you have anything else you do there?
No, I mean, value is like completely fair game. When value is outperforming, it does tend to trickle into the sectors, right? Like think about a value heavy sector like financials, perhaps, right? So the value and growth tilts are almost coming by the nature of my sector investing. So I'm kind of trusting that. I've not been big into other factors like, dividend paying companies or anything of that nature. But certainly are environments in which you should be a little bit more exposed to things that are interest rate sensitive and otherwise. So in my own investing, the way I see it is that I have this core sort of long-term portfolio, and then at times I'll supplement it with something that I feel high conviction in, or multiple things. And usually it's when I feel like the market is quite strong and has a concentration or leadership is concentrated in technology, which by the nature of my primary exposure in the ETF, if technology is like the winning sector, I want to supplement that ETF exposure with technology stocks, right? Because that's where I'm going to get, I'm able to generate more alpha that way. And I believe that they are, the breakouts that we see in technology, they do tend to generate momentum. It's sort of like the darling of the markets, right? I mean, if I had to measure how many questions I get about anything that's not a technology stock, I would say maybe it's like, 30%, right? I'd say it really is primarily technology, maybe secondarily consumer discretionary, and healthcare maybe a distant third in terms of what people are focused on. So technology is the darling because with these technology stocks, you often get, long-term trends of innovation, right, that people are trying to leverage. And then for me, from a technical perspective, you're getting often a high beta type of position or a source of upside leadership, like a semiconductor stock. If you look at semiconductors over history, they do tend to outperform in strong tapes, right? So I kind of believe in supplementing a core kind of conservative portfolio, whether it's 60/40 or just S&P 500 with those technology positions when we have a bull market environment. Of course, there's always the question, is this a bull market environment, right? That's the hard part, right? Is to know, you have to identify the prevailing top-down influences and then make those informed decisions.
How do you feel about international exposure? Do you invest internationally at all? I mean, that's been a big debate, like in our world, because in theory, international exposure should be great. But in the past 30 years, it's been kind of a catastrophe. The US has just been killing everything else. Like, how do you think about that? Do you use technicals there? Do you invest internationally at all?
We totally use technicals there. I'm not really highly invested typically in an international, but my advisor certainly has some exposure there. And like you said, Jack, I mean, the long-term relative trend is pretty bad, and that goes for developed global versus U.S. and then also emerging markets versus U.S. But there are certainly times at which the environment, whether it's based on the dollar or something different, it is quite conducive to relative performance for a shorter period from international stocks. And the way I will express a view typically with that in mind would be on the country level via an ETF, because that's what I'm comfortable with. I can't say I have any edge in evaluating the individual stocks there. I can certainly have an opinion, of course. But in terms of stock selection, I think that's better left to the folks that are focused in those international markets. So instead, I make kind of country bets, if you will. Japan breaking out from a 6-month consolidation. You can express that via ETFs quite easily. We launched a report called the ETF Navigator. And we did that because we had, I'd say most of our questions, if they weren't about a technology stock, were probably about an ETF. So we feature like 60 ETFs in that report. And those ETFs to me are like a great source of expressing a view that is either factor-based or country-based or, sort of a sector or group theme, like thematic ETFs. You can invest in cloud computing companies or, lithium battery companies via ETFs. And I think that's, in a way, the way to go. You get that sort of inherent diversification. So we track all of these ETFs, which are usually pretty liquid and popular. And we'll evaluate them not just as sort of an absolute chart, right? We'll look at that, obviously want to see the trends there. But we'll compare them against each other using like rotational works. In the same way that we evaluate sector rotation, we're going to take all the thematic ETFs and throw them up against the spiders and just see which ones have the relative momentum too that are poised to outperform. So that's how I would say we would approach it. International would fall into that kind of supplemental positioning.
Yeah, for those of us who have invested internationally in the past decade, we probably wish we had called you up and used some technicals because it would certainly have improved the outcomes relative to the buy and hold.
I do appreciate the rationale behind identifying these opportunities overseas, like in China, which of course has been really out of favor. And, I understand why people are interested, right? And I think it's all about position sizing, right? Where, in the same way that I like the idea of having, 5% exposure to cryptocurrencies, I think you should have some small percentage of exposure to international markets. And then if you can do it in a systematic fashion, even better. And if you can do it in a dynamic fashion, even better, because that way you're taking some of the emotions out of it, just keeping the trends on your side. And then also not just, being hopeful that China will finally turn, but rather let the charts kind of guide you and say, well, Brazil is acting much better, that type of thing. So let the charts guide you as to what country is working right then and there. And then obviously, if you have an opinion from more of an economic perspective, then just use that as another filter.
Just one more for me before I hand it back to Justin. We've talked about stocks, we talked about bonds, commodities. Is there anything else like in the liquid portion of your portfolio that you do, or does that pretty much cover it?
No, I mean, money markets, T-bills, things, and this is such a topic last year, right? And the money market funds were paying 5%. I don't think that will be the case for a long time. So we enjoyed it while it lasted, but it also means there's probably a lot of cash out there. So I was, sort of, I guess, involved, right, in these money market funds too. But that's about where it ends for me. I'm not saying that that's the right way to do it, but it's just more what I've had capacity for, right? So I'll always like park it, right, in a money market fund or a T-bill type of ETF as a way to just get some safety when either as a placeholder, right, where I'm looking for an entry in something that's a little bit more exciting perhaps, and then I'll just have it as a placeholder, or because I think there's some risk, right, to the equity market and it's just a safer place to hide.
Going back to the point you made earlier about the interest from investors in technology companies, there was this chart on Twitter this morning that was basically like it was from the Bank of America Merrill Lynch fund survey, and it was tracking going back to like 2014, the most crowded trade. And there's all these different lines and there's these little labels that are labeling like what the most crowded trade was. Well, all the way through that time, there's sprinkles of large cap growth, technology stocks, NASDAQ, and yet the most crowded trade was probably one of the most profitable ones. And I think the technicals would have kept you in there for the most part. Whereas, a lot of people at different points there were saying it was the most crowded trade and probably all the money's been made.
Yeah. And that's like, it comes down to reconciling, I guess, valuations and sentiment. As a technician, I'm not like a strict behavioral finance person, but I do believe that market sentiment is pretty much the most important influence. Now, market sentiment comes from a lot of different places, right? So it's almost like the end result of all of that other information that's out there too. But every sort of bit of information gets narrowed down into a buy or sell decision. And if people are buying something and it's trending higher and it has the support of those momentum gauges, well, of course, you want to just stay on the right side of that. And there are times at which I would say it becomes against your better judgment because it does feel crowded or it does feel like it's overextended. And we will kind of take our emotions out of that type of situation and say, okay, well, here's what's going to, change that trend for us. So here's where we're going to be out of it. And it can be something as simple as like a 20-day moving average. Watch a 20-day moving average. And if it's trending higher, great. Keep that on your side and hold that position, even if it's a little bit extended in your view. As soon as that starts to roll over, maybe reduce partial. And maybe if it takes out the 50-day moving average, you reduce the full position. And like in an area like the home building stocks, I think that's a great way to trade them because they were pretty unstoppable, and they were unstoppable at a time when it didn't seem to make a lot of sense from a macro or fundamental perspective necessarily. But because they were working and they had these steep uptrends, that kind of discipline would have been really helpful in that sort of environment. And then, by watching the momentum or the trend, you can avoid those corrective phases, some of those prolonged corrective phases. And then you just had to make sure that these would be more from like a trading perspective. But with a long-term trend, you could narrow, or you could actually sort of zoom out from something like that's trend sensitive, like a 20-day, and just use something that's longer term, right? And say, okay, well, I'm willing to watch this go against me, by 10% or something like that. Have your mental threshold percentage wise, but know that the primary trend is still supported by these indicators.
You had mentioned the 5% of the portfolio potentially in crypto assets. Is that something you actually do and invest in? And it would seem to me like that technical momentum would be very strong on crypto.
I did have a crypto position when it was working, and then like so many others, I got a little spooked by the bear market cycle. So dynamically, I'm not as exposed to crypto as I was, or as I should be, really. We do cover the cryptocurrency markets on a weekly basis, so I'm really very close to it. Out of sort of, I don't know if you call it laziness or just not having dedicated sort of my time or money to it, I don't have a position right now, but I believe in a position. We are bullish and have been bullish intermediate term for some time on the likes of Bitcoin and Ether. So I believe in having a small position, not even just because of the trend, right? But because of the diversification that an asset class that, well, sometimes is tied to equities, but other times it really isn't. I like that the market's giving us some more choices, and even when gold isn't doing great, I like the idea of having some gold exposure. So I like the idea of being diversified, among asset classes, but to let the percentage weightings be somewhat dynamic based on their trends. So right now, I feel like cryptos have really turned the corner, and I am interested in building exposure. And I certainly welcome the news of the spot ETF. I just think that's going to make it much more investable.
Yeah, I find it interesting that as soon as that got approved, it's like Bitcoin ran up. Well, they all did the run up into it, and then since the announcement, they're down. So it's like, what is going on?
It's
But that's how that works.
classic, right? Sell the news. But what was interesting with that pullback is that Ether just shrugged it off. So Ether just kept all of a sudden the ratio between Bitcoin to Ether just reversed in favor of Ether very, very abruptly. And so it made you think that, well, people really had run up Bitcoin ahead of that news, right? And in a way, Ether sort of suffered under that, even though it was going higher. It was lagging for actually quite a long time. So maybe we'll see the relative performance shift a little bit.
How do you think about the value of your business in your overall, I guess, net worth? Is that something you think about, or is it just kind of you're day to day trying to grow the business and you really don't assign a value to it because who kind of knows what the value? I mean, you probably could do like a discounted cash flow valuation on it and figure it out if you really want to. But do you think about that at all? And do you think you do anything differently because you are exposed to maybe a little bit more market specific risk or variability in the profitability given what's going on in the market?
You're making me laugh. Because I mean, you say DCF, models, that's obviously not what I do. So when I think about my business, I am more of the latter, meaning I'm there like, fighting the good fight and trying to grow the business every day. But really what I enjoy about it is the markets, right? So I spend as much time as I do on the business as on the research and the consulting. So I really am in it for that. And I can't say that I have, a specific valuation in mind, excuse me, as it pertains to my overall sort of investments and things like that. But what I will say is I just like trends, right? So as a technician, it's most important to me that I feel like the trends are good, right? And then that gives me more confidence. So I almost think of the business as much as it's intangible in a way. I don't have a price chart of Fairlead Strategies, but I do have in mind the prevailing trends, and we've certainly seen in our 6 years now, the right trend. So I would say we're at this point in the long-term uptrend in terms of our growth and our reach, and and our people. We have a really great team. So those are the things that I feel like, get me excited. And there are, those market environments in which we're just going to, sort of struggle alongside most of Wall Street, quite frankly. And so we consider those to be pullbacks, right? So I think about a pullback and a long-term uptrend as being healthy. What we don't want to see, of course, is some kind of bearish reversal for Fairlead. And so far, knock on wood, so good. But, a growth trend is what we want to see.
Want to ask you one more and then get some of your thoughts on the market environment, what you're seeing under the surface. But this one is about kids, and you're a mom, you have young children. Jack and I both have young children as well. And, we just like to ask and get perspective from different people as to how they view, leaving some money to their children, or how they view that. Like, we've talked to some very wealthy people, and some people have said, they've actually think they've left too much money to their children. That's not good. Others have said, they kind of want to set their kids up to get them started maybe after college, but then after that, they're on their own. So how do you sort of view that?
Yeah, honestly, it's a good question and it's something I should think more about, more of the kind of macro version of that versus the micro, which I think I'm more focused on. I'm really more focused right now on, making sure that the kids aren't too spoiled, which I think, based on what I'm reading out there, we've almost got a problem right now, and where young children, the ages that I just read something on Insider about 10-year-olds in Sephora going in and dropping a bunch of money that, the workers at Sephora are saying, I don't even have that in my bank account, so there's a little bit of, I think, a trend towards young people, almost like, having access to too much money, going to Starbucks, going to Sephora, spending a lot of money and not having that sort of personal finance knowledge yet. So I've been more focused there, I would say, which is more the micro version of that question, to make sure that my kids are developing good habits in terms of their spending. So that's been more my focus now. But I think it's just in the same way that my parents taught me to save. It was more the traditional, like, try to sock away 10% of your income every year and compounding, et cetera. I'm trying to instill that value in them. And at the same time, my sort of primary goal in making money is truly to support their education. So that to me is I don't want to say it's why I work, but it really is a primary driver of me working so hard. It's also kind of my personality. I'm just generally sort of multitasking at all times and what have you, but I really want to build my wealth in a way to support them through their education. And it doesn't mean, I leave them high and dry once their education is done, but I do want them, of course, to be self-sufficient.
Yeah, it's funny on the Sephora thing. My daughter, I've know nothing about Sephora, but the other day she was like making a cart like on her iPad at Sephora, and she's like, "Oh, it's $300," and I was like, "Wow, I had no idea you could spend that much money at Sephora." Obviously she didn't get any of the stuff she was trying to get, but I had no idea. She's 9 years old, but like girls these days, I guess, Sephora is kind of a big thing.
Yeah, these girls are influenced by the influencers, right?
Right.
They just have access to more information than we did, and there's good to that, and obviously there's a flip side to it as well. But the joy that they have just walking through CVS, it's like the consumerism. It's really prevalent. Whereas my son, he's a little bit less interested in that. So it's just a matter of trying to make sure that they're aware, right? Because what the last thing I want to see from my kids would be somebody, going up to a counter and not having an idea of what something costs, right? And that happened to one of my daughter's friends, where she actually bought something and she never looked at how much it cost. It landed on her parents' credit card, and that's where the shock came, right? It was, and really, she didn't have any negative intentions, of course, right? But just didn't think to look. So that's something we need to teach them.
Let's get into the market a little bit as we wrap up here. So give us a rundown of what's going on currently in the market, what you're seeing in the short and midterm, and maybe where the opportunities are as we sort of start 2024 here.
Yeah, I mean, I am bullish, and I'm bullish primarily because of the action that we saw in Q4. Yeah, I was bullish on the S&P 500 last year, probably as of the breakout that occurred in early May. But this is a bigger breakout that we have as of Q4. So it's not just sort of an extension of the cyclical uptrend. It's something that shows the breadth has really improved. So as an example, the S&P 500 broke out above 4,600, which was a strong resistance level on the chart. And then also we saw a little bit later the advanced decline line, which is a measure of market breadth or participation, reach a new high. So these mutual breakouts in price and in breadth or participation, to me, are what dictate a bullish bias for probably most of this year based on the implications of the breakouts that we've seen. So those breakouts occurred not only in the major indices in the US, but also in sort of the bottom up work that we do, the sectors. You can see a lot of breakouts on the sector level. You can see, and by the way, that wasn't really the case even back in sort of middle of last year. We had sort of more narrow leadership as has been well publicized. And then globally, I mean, we have big breakouts in a lot of overseas markets. And I think that global breadth is something else that really differentiates Q4 from the earlier stages of the bullish reversal post 2022. So I am bullish for the breakouts, for the improved breadth that seems meaningful, for the fact that it is global in nature, and the implications of all of that for our long-term indicators. So looking at those same monthly bar charts that are guiding our ETF, we have really very compelling setups in our indicators on that time frame. So as much as we've seen a pullback here at the start of 2024, and I know that has people a little bit on edge because of the January barometer from the Stock Traders Almanac and other seasonal implications, but I think we have to contextualize the pullback within the very strong up move that preceded it. It's very rare to see 9 weeks of upside from the S&P 500 consistently. So to see a couple of weeks that have a lower bias, I actually think is quite healthy. So now we're in this mode that we expect a little bit more consolidation near term, but rather than telling people to get hedged, we're more in the mode of, hey, just, stick with your exposure that's exhibiting positive intermediate term momentum, and it hasn't seen deterioration on the weekly charts. But wait to add exposure until we have a little bit more of a convincing evidence from. We use primarily the stochastic oscillator for timing re-entries, and we don't quite have that yet. So it could happen next week, it could happen in 3 weeks, but we do think it will happen relatively soon.
As we get towards the end of these, we like to ask a question that gets at the idea that not everything we invest in, has a financial purpose. And I always give the example, like I have a sailboat, and I have a racing sailboat, and I enjoy like going out with my friends and going on these Wednesday night races and having a beer. And if you look at that purely as an investment, it's a terrible investment. It requires upkeep. Constantly have to spend money on it. But I'm wondering if there's anything like that in your life. Is there anything you like to spend money on that maybe is not a great financial investment, but you get a lot of benefit from it in your life?
It's funny, Jack. I didn't know that. We'll have to talk more offline about sailboat racing. It's something that I've done sort of for 20 years plus, and I love it.
Oh, cool.
And I see how these so-called syndicates, they can drop so much money on just one race, right? So I can see how, especially if they're serious and getting new sales and what have you. So boats are notorious money pits, and I would say especially racing boats. You'll notice that Fairlead, if you look at our website and our sort of branding, there's a little bit of a nautical element to it. Fairlead is a little part on a boat. It's this little sort of guideline to make sure that the lines don't get tangled. So Fairlead is a nautical reference, and so is TAC, as you can imagine, right? So anyway, so we'll have to talk about that. But I would say for me personally, it's more travel because I really love to travel, and I've always loved it. And I kind of drag my whole family to all these places, and sometimes we have like places that are total hits with everyone, and other times not as much. And travel, of course, has gotten so expensive, really since post-COVID, I would say. So we've at times probably outlaid more than I personally should, right? On a trip that, is 2 nights or 3 nights, right? So I think that's probably my hotspot, if you will, in terms of things that might be a bit of a drain and probably at times more than I can really justify. But I also value that just in the same way that you value having this experience every Wednesday. I really value the excitement of planning the trip, the, sort of getting everybody off of their devices for a few days and focusing on something new and different and seeing that there's a big world out there. So it's an enriching experience. I think that is sort of worth it to me, if I had to put it that way.
So we like to ask all of our guests sort of a standard closing question, which is if you could impart one lesson to the average investor that you've learned from building your own portfolio, what would that be?
Oh, goodness. Yeah. I mean, I would say certainly the long-term focus. To go back to that, I don't want to belabor that point, though. But I would say that not only the long-term focus, but just the systematic approach. I think the biggest problem probably in building a portfolio is not having defined risk metrics, right? So we always want to make sure that we know what we're risking, right? We want to obviously have unlimited upside. But obviously, if you're making an investment, you believe in that, but you just really need to know what you're willing to risk on that position individually, and then within, the broader context of your portfolio. So risk management, which can be achieved through stop losses, it can be achieved through using indicators to discern a meaningful shift, or it can be achieved through asset allocation. So there's a lot of ways to do that, and maybe some combination of those ways is best. But that's the lesson learned. And I can't say it comes from like a specific position that went wrong for me. But it's something that, we've all been through that where we just are watching something and we either it gets off our radar for a little bit and we just say, I can't believe I let that go against me for that long. So I think it's to avoid that type of position. And it is, it takes a little bit of work, and that's, it means that we have to dedicate some time to it.
Katie, this has been great. Thank you very much for coming on, talking about this, different than what you talk about most of the time, but it's been excellent. I think our audience is going to learn a lot from this. So we really appreciate it. Thank you.
Of course, Justin. Thank you both. Nice to see you.
This is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJCarbonell. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.
Justin Carbonell and Jack Forehand are principals at Fairlead Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Fairlead Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Fairlead Capital.